Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise the income from other sources chapter for CA Intermediate Income Tax syllabus. But before beginning the revision, as usual, my request to you is to like this video, subscribe to this channel dear if you have not already subscribed, and also leave a comment if you find this video helpful, and share it with your friends because sharing is caring. Now without further ado, let us begin the revision. Income from other sources head of income is the last and the fifth head of income, and it is also called the residuary head of income. Residuary head of income means what? If at all there is an income that is taxable under the Income Tax Act, but it is not covered under any of the four other heads of income, then such income will be covered under the income from other sources. Okay. But apart from being a residuary head, there are certain incomes that are taxable only in income from other sources. For example, winnings income, dividend income, etc. Hence, if an assessee is earning dividend income, it will always be taxable in income from other sources. Okay. Now, like any other head of income, even income from other sources has a charging section and a computation section. The charging section is given under section number 56 and computation section is given under section number 57. Now let us discuss the concept by concept in income from other sources. Firstly, let us discuss the most important concept in income from other sources, that is section number 56 to 10. When does section 56 to 10 apply, sir? Kanna, 56 to 10 will apply when an assessee is receiving money, movable property or immovable property from any person without consideration or for inadequate consideration. In such case, 56 to 10 will apply. And fondly, that is pasama, we are calling this section as taxation of gift. In Income Tax Act, it is not written that this is taxation of gift. We are only commonly calling it as taxation of gift. Okay. But be clear with certain points. What are those points? Point number one, this section you should refer only if the money, movable property, immovable property that is received without consideration or for inadequate consideration is other than those covered in salary head of income and PGBP head of income. Hence, if the employer is gifting any amount or asset to the employee, then see the salary head of income. If a person is receiving any gift in the nature of business or profession or in the course of business or profession, then refer the PGBP head of income. Only if in those heads it is not covered, only then it will be covered under 56 to 10. That is point number 1. Then this section, that is 56 to 10, is applicable to all the assessees. It is applicable to all assessees. But in certain cases it will not be applicable. In certain cases it will not be applicable. So before learning this section, let us learn the exception of this section. Exception of this section. So what are the exceptions of 56 to 10? Let us study one by one. So first exception is transactions not regarded as transfer, but in that only certain transactions are exception to this particular section. What is transaction not regarded as transfer? Section number 47 that we learnt in capital gain chapter is transaction not regarded as transfer. There are many provisions, when amalgamating company is transferring to Indian Amalgamated, okay, resulting is transferring to demerged is transferring to resulting company, then preference shares are converted into equity shares. So for all those transactions, this 56 to 10 will not apply. Hence, when the transferor is giving the asset, capital gain will not arise. When the transferee is receiving the asset, 56 to 10 will also not arise. Hence, there will not be any tax for those transactions. However, only certain transactions are covered, certain transactions are not covered. In section 47, we learned that even gift is covered in section number 47. Hence, when a person is giving a gift from one person to another person, it is a transaction not regarded as transfer. That is why capital gain will not arise. However, when a person is receiving the gift, okay, the person who is receiving the gift must pay tax under 56 to 10. Hence, when gift is received, tax has to be paid under 56 to 10. Income will be considered. Okay. Next, if any gift is received from relatives, it should not be considered under 56 to 10. Now, who are the relatives? See here. A relative of an individual is the spouse. Spouse means what? For a husband, the wife will be called the spouse. For a wife, the husband will be called the spouse. So, spouse, then brother or sister of the individual, brother or sister of spouse of the individual is also relative. Lineal ascendant and lineal descendant of the individual is a relative. Lineal ascendant means what? Parents, grandparents, great grandparents, etc. Lineal descendant means what? Children, grandchildren, great grandchildren, etc. So lineal ascendant is also relative, lineal descendant is also relative. Similarly, lineal ascendant and lineal descendant of the spouse is also relative. Next, brother or sister of either of the parents of individual are also relative, but not of the spouse. So my parents brother or my parents sister will be my relative. Okay, so let me take the relative definition once again, very important. So for an individual, spouse is the relative, brother and sister of the individual, brother and sister of spouse of the individual. Lineal ascendant, lineal descendant of individual, lineal ascendant, lineal descendant of spouse of individual, then brother or sister of either of the parents of the individual but not of the spouse, and spouses of all the above will also be considered as individual. And in relative definition, no, one thing you have to be very clear. What is that one thing? That relationship is not vice versa. Relationship is not vice versa. It means what? If I am the relative of some other person, it is not necessary that they are also my relative. Okay. So listen here. I gave you an example also. For example, my father's brother is my relative. My father's brother is my relative. But so hence what will happen? If my father's brother is giving me a gift, it will not be taxable under 56(2)(10). However, for my father's brother, am I a relative? Answer is no. Nowhere it is written that brother's son is relative. That is why if I am gifting anything to my father's brother, then he will have to pay tax under 56(2)(10). That is why relationship is not vice versa. He is my relative, but I am not his relative as per the Income Tax Act. So this you have to be very careful. Then for a HUF, members of the HUF are relative. Okay. Now we know what is relative definition. If any gift is received from the relative, then it is totally exempt. It is not required to be taxable under 56(2)(10). Next, if any money, movable property or immovable property is received through inheritance or will, then also it is not taxable under 56(2)(10). Next, if any movable property, immovable property or money is received on the occasion of marriage, then also it is not taxable. However, remember that is only on the occasion of marriage, not on the occasion of marriage anniversary, birthday party, etc. etc. Only marriage is covered in exception. Hence, on the occasion of my marriage, if someone is gifting me something, then I need not consider it as an income under 56(2)(10). Next, on contemplation of death. On contemplation of death means what? While a person is going to die, okay, on deathbed, if the person is giving any money, mobile property or immovable property without consideration to some other person, then in the hands of receiver, it will not be taxable under 56(2)(10). Okay. Next, if any gift is received from local authority, it is not taxable under 56(2)(10). Next, if a gift is received from an individual to a trust solely created for the benefit of relative of individual, then also it is not taxable under 56(2)(10). For example, for the benefit of my son, I have created a trust, and to that trust I am giving the money, movable property or immovable property. In such case, the trust need not pay any tax under 56(2)(10). There will not be any income under 56(2)(10). Next, section 1023C and 12AA. So if there is any organization that is registered under 1023C or 12AA, then to such organization, if we are giving the gift or they are giving us the gift, so to and from both are covered. For both transactions, there is not income, there is no income under 56(2)(10). So even if they are giving me the gift, I need not pay any tax. If I am giving them a gift, they need not pay any tax under 56(2)(10). Next, other cases as may be prescribed. And there is one prescribed case if there is any immovable property received by a resident of unauthorized colony of Delhi. So if a resident of unauthorized colony of Delhi is receiving immovable property, then such immovable property need not be taxed under 56(2)(10). You get my point? So these are all the exceptions under 56(2)(10). I also gave you a code word to remember all these exceptions, which is TRIM CD Lab 1023C 12AA Delhi. So if you remember this mnemonic, you will be able to memorize all the exceptions. Now we have learnt the exceptions. Let us jump to the main section. So what does the section say? Firstly, let us talk about cash. Here cash does not mean physical cash. Here cash means money. So if money is received by a person, then The aggregate amount of cash received during the previous year, if it exceeds 50,000 rupees, then the entire amount is taxable. If the aggregate amount exceeds 50,000, entire amount is taxable. I gave you an example also. One of my friend gave me 30,000 during the year. Another friend gave me 25,000 during the year. So totally how much did I get? I got 55,000. Hence the entire 55,000 will be taxable. Since it exceeds the 50,000 limit, entire amount will be taxable. Now let's talk about immovable property. Let's talk about immovable property. Immovable property means what? Land or building or both. If an immovable property is received without consideration, then see what is the stamp duty value. See what is the stamp duty value. If the stamp duty value per transaction, so here you should not take aggregate value, you have to consider per transaction. If the stamp duty value per transaction is more than 50,000, then the stamp duty value will be taxable under 56(2)(10). Next, let us talk about inadequate consideration. Inadequate consideration means what? I am paying consideration, but that is not adequate. It is lesser than the stamp duty value. In such case, what you have to do? Listen here. You have to do step 1. 50,000 or 10% or 20% of the consideration, whichever is higher. 50,000 or 10% or 20% of the consideration, whichever is higher. When you have to take 10%, when you have to take 20%? Answer is generally you have to take 10% as the consideration. Generally 10%. However, in only one special case you have to take 20%. What is that special case? It is the case which is covered in section 43 CA, which we have discussed in PGBP chapter. Capital gain chapter. PGBP section is there, section 43 CA, in which if a builder is giving a residential unit to to the person who is receiving the residential unit, and if the consideration is up to 2 crores and if it is received within the time period that is prescribed under that section, then instead of 10% you can take 20%. So you have to link it with section number 43 CA, which we have already studied. So in that case alone you have to take 20%. In all the remaining cases you have to take 10%. So take 50,000 or 10% or 20% of the consideration, whichever is higher. Then see, if stamp duty value minus consideration is more than the higher amount, if stamp duty value minus consideration is more than the higher amount, then stamp duty value minus consideration will be taxable under 56(2)(10). However, if it is lesser than the higher amount, then there is no income under 56(2)(10). So listen once again what you have to do. 50,000 or 10% or 20% of the consideration, whichever is higher. Then take this higher amount and compare it with stamp duty value minus consideration. If stamp duty value minus consideration is higher, then the stamp duty value minus consideration will be taxable under 56(2)(10). If it is not higher, then it will not be taxable. Okay, very simple. Now let us talk about movable property. What is movable property? Only JADPAS BS, JADPAS BS is covered in movable property. All other movable property is not covered in 56(2)(10). What is JADPAS BS? Listen. Jewelry, archaeological collection, drawing, painting, any other work of art, sculpture, bullion and shares and security. Repeat once again. Jewelry, archaeological collection, drawing, painting, any other work of art, sculptures, bullion and shares and security. All these are movable property that are covered under 56(2)(10). Other than these property, no other movable property is covered. Hence, if an assessee is receiving any movable property which is not covered here, for example, he is receiving an electric vehicle or a car or a mobile phone or a watch or furniture or any movable property that is not covered here, then it will not be taxable under 56(2)(10). Only the movable property that is covered here will be taxable. Okay, that is point number 1. Now how to calculate the tax? Listen, how to calculate the income? Let us see. If the movable property is received without consideration, then if the aggregate fair market value is more than 50,000, then the aggregate fair market value is taxable. I gave you an example also. Okay, one second. So see here, if I am receiving from my friend shares worth rupees 20,000, then one more friend is giving me gold bullion worth rupees 34,000. So totally how much value of gift that I have received? Answer is 54,000. Total it is 54,000 during the year. Since it is more than 50,000 rupees, hence the entire 54,000 will be taxable under 56 to 10. It will be considered as income under 56 to 10. You get my point? Now let us talk about an inadequate consideration. If movable property is received for inadequate consideration, then if the difference between fair market value and consideration is more than 50,000, then the difference amount will be taxable. Aggregate difference amount will be taxable. You get my point? So this is the concept of 56 to 10. I hope you are very clear. And also one more special point. See, I told you, no, we have to compare it with stamp duty value minus consideration. In such case, stamp duty value we have to take on which date? Generally, you have to take the stamp duty value on registration date. However, if on or before the date of agreement, if there is any full or part consideration that is paid through account pay check, account pay bank draft, electronic clearing system, or any other prescribed mode, in such case you take the date of agreement. Okay. This is the same provision that we discussed in section 50C and 43CA. Fine. Now let us discuss the next part. Okay, one more thing I wanted to tell. See, listen here. Here also, if assessee is not satisfied with the stamp duty value, he can refer the case to valuation officer, and all those valuation officer points will be applicable that we had studied in capital gain chapter under section 50C. So that is applicable also to 56 to 10. Then 56 to 10 is applicable only if the asset is received is a capital asset. Hence, if someone is gifting me an asset and if that asset is a stock, then I should not see 56 to 10, I should see PGBP chapter. Only if I am getting a gift and if that gift is a capital asset, I should consider 56 to 10. And then one more thing, if an amount is taxed under 56 to 10, then the value of that asset which is considered for 56 to 10 will become the cost of acquisition for future purposes. This also we have already discussed in capital gain chapter. Okay. Now next let's talk about taxation of dividend. So what is dividend? If the profit of a company is distributed to the shareholders, it is called as dividend. Dividend is taxable under income from other sources at normal rate of tax. Earlier dividend used to be exempt and all, but that and all is not applicable now. Now what is applicable? If dividend is received, it is fully taxable under income from other sources. However, there are 5 cases where the Income Tax Act will deem a transaction as dividend. That is, even though it is not a dividend, still the Income Tax Act will tell that it is a dividend. But be sure about one point, that this deemed dividend is only up to the extent of accumulated profit of the company. Accumulated of profit of the company. Sir, what is this accumulated profit? Accumulated profit means profit that gets accumulated over a period of time. That means the profit which is there in the hands of the company, only to the extent of that profit it can be considered as deemed dividend. Now, accumulated profit can be of 2 types. Capitalized accumulated profit, not capitalized accumulated profit. Capitalized accumulated profit means brought to balance sheet. Not capitalized means not brought to balance sheet. Okay. Now, there are 5 sections of deemed dividend: 222A, 222B, 222C, 222D and 222E. For the first 4 sections, 222A, B, C, D, for the first 4 sections, what will happen? The entire amount of accumulated profit, whether it is capitalized or not capitalized, both will be considered as deemed dividend. Both will be considered as deemed dividend. That is the maximum limit. However, in case of 222E, the amount only up to a maximum of accumulated profit that is capitalized will be considered as deemed dividend. So what did I say? Maximum deemed dividend can be accumulated profit. Accumulated profit. For the first 4 provisions, that is 222A, B, C and D, accumulated profit can be capitalized also, not capitalized also. But for 222E, we have to take only capitalized accumulated profit as the upper limit. Okay. So I hope you are clear. If you are not able to understand also, it is not that important. You can forget it, no problem. Let us focus on the concept. So firstly, let us discuss section 222A, A for asset. 222A, A for asset. So if any asset is distributed by a company to its shareholder, then when the shareholder is receiving the asset, that asset is deemed as dividend in the hands of shareholder, and the value of that asset should be considered as income from other sources, and the assessee has to pay the tax, but only to the extent of accumulated profit. Next, section 222B, B for bonus. So there are 2 types of transaction that is covered in section 222B. What is the first transaction? If there is any distribution of debenture, debenture stock or deposit certificate to shareholder. Debenture stock or deposit certificate to a shareholder. And second transaction is bonus shares given to preference shareholders. Bonus shares given to preference shareholders. In these two transactions, the person who are receiving the security, for them it will be considered as deemed dividend, and they have to consider it as income to the extent of accumulated profit of the company. You get my point? Next, section 222C, C for close. C for close. So 222C means what? A company is closing down, means it is liquidating. Hence, if any company is distributing the assets on liquidation, then to the extent of accumulated profit, the assets distributed will be considered as deemed dividend in the hands of the person who is receiving the asset. Okay. Next, section 222D, D for decrease in share capital. Hence, if any distribution is done by a company to its shareholders by way of reduction of share capital, then to the extent of accumulated profit, it will be considered as deemed dividend. So for example, there was a 10 rupee shares, it was decreased to 2 rupee shares, and balance 8 rupees is distributed to the shareholders as dividend. It is distributed to shareholders, it will be considered as deemed dividend. Now let us discuss about section 222E. When will 222E apply, sir? Answer is generally 222A, B, C and D. All these four sections applies to all the companies. It applies to all the companies. But 222E will apply only to closely held company or unlisted company. Closely held company or unlisted company, or in short, both of them together you can call it as company in which public are not substantially interested. Company in which public are not substantially interested, which is nothing but closely held company or unlisted company. So if there is a closely held company or unlisted company, and if it is giving loan or advance to a shareholder who is having 10% or more voting power, if closely held company or unlisted company is giving loan or advance to a shareholder who is having 10% or more voting power, then in the hands of shareholder, that loan will be treated as deemed dividend. That loan will be treated as deemed dividend, and he has to consider it as an income under income from other sources and pay the tax. Okay, it does not matter whether the loan is given at an interest rate or not, whether the loan is repaid or not, whatever it is, it does not matter. If a loan is given by a company to such shareholder who is having more than 10% voting power, such loan will be treated as dividend. You get my point? Similarly, even if a loan or advance is given to any concern in which the shareholder is having substantial interest, if the loan or advance is given to any concern in which shareholder is having substantial interest means what? 20% or more voting power, or 20% or more profit sharing ratio, as the case may be, then also such loan or advance will be treated as deemed dividend in the hands of shareholder. And also, if such company is giving loan or advance to any person for the benefit of the shareholder or on behalf of the shareholder, then also such loan or advance will be treated as deemed dividend. You get my point? Now, see, listen, but this deemed dividend only will be to the extent of accumulated profit, which is capitalized, as I already told you. Then, even if loan is repaid or interest is charged at market rate, it will not make any difference in this particular section. However, listen here. Let us see exception to deemed dividend. Exception to deemed dividend. Exception number 1. If a loan or advance is given in the ordinary course of business of money lending, where money lending is the substantial part of business. So if a shareholder is receiving loan from the company and the main business of the company itself is giving loan, in such case, then the loan will not be treated as deemed dividend. Number 2. If there is a dividend paid by the company and that is set off against the loan or advance already deemed as dividend, that is covered in exception. So listen here. For example, I am the shareholder. Okay, a company has given me a loan and this loan is deemed as dividend in my hands. That is why I considered it as an income and paid the tax under income from other sources. Now later on, the company wants to give me actual dividend. So what did the company do? The company told me, you do not repay us the loan amount. You set off the dividend against the loan amount. Okay, and you keep it with yourself. Hence, now my loan is converted into real dividend. Now my loan is converted into real dividend. Hence, when my loan is converted into real dividend, should I pay tax on that real dividend? Answer is no. I need not pay the tax because I have already paid the tax while considering the loan as dividend. You get my point? If you are able to understand, well and good. If you are not able to understand, whoosh, rub it off your head, no problem. Next, buyback of shares will not be considered as dividend. And next, if shares are allotted to shareholders of a demerged company by a resulting company in course of demerger, then also it will not be considered as dividend. If there is any distribution under section 222C and 222D for preference shares, then it will not be considered as deemed dividend. So 222C and 222D does not apply to preference shares. You get my point? So this was the entire concept of dividend. I hope you were able to understand. Now let us jump to all the remaining concepts. Firstly, let us discuss section 56 to 7b, shares issued on premium. So if any shares of a closely held company or unlisted company, what did I tell? Closely held company or unlisted company, if it is giving a share to a resident shareholder, then what will happen? If the shares are given at premium means what? Price above face value. Premium means given at a price above the face value. Then income from other sources will be issue price minus fair market value. Issue price minus fair market value. So this is a tricky section. When will this section apply? Number one, it will the section will apply only if the company is a closely held company or unlisted company and it is giving the shares to resident shareholder, and if shares are issued at premium. Premium means what? A price above the face value. Price above the face value. However, what will be income from other sources? Income from other sources will be issue price minus fair market value. Okay, not face value, issue price minus fair market value. So while seeing the condition you have to consider face value, but while doing the calculation you have to consider fair market value. So be very careful. Next, section 56 to 11, compensation on termination of employment. See here Kanna, generally compensation on termination of employment is covered in salary head of income because there will be employer-employee relationship. However, if there is no employer-employee relationship, compensation of termination of employment will be covered under income from other sources. For example, A is giving B 1 crore rupees to quit his job, but A is not asking B to come and join him. Hence, between A and B there is no employer-employee relationship, but this 1 crore is a compensation on termination of employment. Hence, that money will be taxable under income from other sources. So I hope you are clear. Now let us come to the next section, that is 115BB. 115BB is called tax on casual income. 115BB is a special rate of tax which is taxing casual income. Now what is casual income? Casual income means winnings from lottery, crossword puzzle, horse race, card games, any other games of any sort, or any form of gambling or betting. So what did I say? Lottery, crossword puzzle, horse race, card games, any games of any other sort, gambling and betting is covered under 115BB. So for all these winnings, tax is charged at a flat rate of 30% plus health and education cess and surcharge as applicable. Flat rate of 30% plus health and education cess plus surcharge as applicable, and this is a very strict section because against this income no expense is allowed, no allowance is allowed, no deduction is allowed under chapter 6A, even basic exemption limit is not allowed, and even no loss is allowed to be set off. What did I tell? No expense is allowed. So for example, if I'm earning lottery income and I paid some money for lottery tickets, okay, that lottery ticket expense also will not be allowed against the lottery income. Okay, so no expense allowed, no deduction is allowed, no allowance is allowed, chapter 6A deduction also not allowed, basic exemption limit also not allowed, and against such income no loss is also allowed to be set off. So very strict section. And while giving the income, the person who is giving that casual income should deduct the TDS also, that you link with the TDS chapter. Okay, rate of TDS is also 30%. Now let's talk about rent. Generally rent is taxed under income from house property. However, if rent is not taxable, if rent is not from a house property, then it can be taxable under income from other sources if it is not PGBP. Okay, then composite income can also be taxable under income from other sources if it is not PGBP. And if I am subletting a house, it means what? I am not the owner of the house, hence the rent that I receive can be PGBP or income from other sources as the case may be. Okay, next, Key man insurance policy. I already told you, if employer is receiving the money from the insurance company, it is taxable under PGBP. If employee is receiving the money, it will be taxable under salary head of income. And if any other person other than employee is receiving the money, it will be taxable under income from other sources. Next, if director remuneration is received from board meetings, then it is taxable under income from other sources, that is sitting fees. Next, income from paper setting, paper checking, seminar fees to professor, etc. from a non-employer organization is also taxable under income from other sources. For example, I am a practicing chartered accountant, but Institute of Chartered Accountants of India is asking me to correct the answer sheet. To correct the answer sheet, for that they are giving me the money. Now, is ICAI my employer? Answer is no. They are not my employer. Hence, the money that I am receiving for this paper checking, etc., will be taxable under income from other sources. Fine. Now let's talk about family pension. Family pension means what? When the employee is no more, then the employer will pay the pension to the family. When the employee is no more, employer will pay the pension to the family. Hence, when the family member is receiving the pension, it is called family pension. Family pension is taxable under income from other sources, and against the family pension, deduction is also allowed. What is the deduction? Deduction will be one third of family pension or 15,000 per annum, whichever is lower. One third of family pension or 15,000, whichever is lower. However, you should link this family pension with the exemption chapter where we learned section 10 clause 18, where I told you that if a family member of a gallantry award recipient is receiving family pension, then it is completely exempt. Okay. Next, interest income. In various other places, we have also discussed interest income. Like in salary chapter, we discussed interest from PPF, interest from RPF, etc. Then in exemption chapter, we discussed interest from Sukanya Samriddhi account, interest from NRE account, etc. So all those places I am not covering once again. Only the balance interest income I am covering it here. So if any interest is received on compensation or enhanced compensation of compulsory acquisition, what did I tell? Interest on compensation or enhanced compensation of compulsory acquisition, against such interest 50% is allowed as standard deduction. 50% is allowed as standard deduction. So for example, if government is giving me 1 lakh rupees as interest on compulsory acquisition, then on such interest 50,000 rupees I can claim it as deduction. Balance 50,000 only will become taxable. So 50% will be standard deduction. Next, section 10 clause 15. If interest is received on gold deposit bond of 1999, it is exempt. If it is received on deposit certificate under gold monetization scheme 2015, it is exempt. Interest from national plan certificate exempt. Interest from capital investment bond is exempt. Interest on relief bonds of RBI is exempt. Then interest paid to non-resident by a IFSC unit, that is International Financial Service Center unit, is also completely exempt. Then, if interest is received from post office saving bank account, then up to 3,500 per year, it is exempt. And in case of a joint account, maximum exemption that can be claimed is 7,000 rupees. Now be very careful. When interest is received on post office saving bank account, then exemption is also given, and that is 3,500 or 7,000 as the case may be, and deduction is also available under section 80 TTA, 80 TTA and 80 TTB. In such case, what to do? First take the exemption, okay, and only on the balance amount you consider the deduction. Fine. So be very careful. All other interest income will be taxable normally, and even income from UTI and mutual fund is also taxable normally. Next, let's talk about deductions. First and foremost, if an income is taxable under income from other sources, then if an expense is relating to that income, it can be claimed as deduction. It can be claimed as deduction. However, there are disallowances similar to the disallowances that we have already discussed in PGBP. What are the disallowances? If TDS has to be deducted and TDS is not deducted, then 30% will be disallowed if the payment is to resident. Then if any excess payment is made to related party, then also excess amount will be disallowed. If payment is made above 10,000 rupees to a person in a day other than account pay check, account pay bank draft, electronic clearing system or any other prescribed mode, then such payment is also disallowed. Then similarly, where there is deemed profit under PGBP, similarly deemed profit of section 41(1), if it is not related to PGBP, it will be taxable under income from other sources. And one more thing, personal expenses will not be allowed under income from other sources. Let us talk about other deduction. If an income is exempt, then the expense related to that income will also not be allowed. This we have already studied in section number 14a. Next, against interest on compensation of compulsory acquisition, 50% is allowed as deduction. For family pension, once again I am telling, 1/3 of family pension or 15,000, whichever is lower, is allowed as deduction. Against winning income, no deduction is allowed. And now let me tell you new concept. For dividend income or income from units of mutual fund or income from specified company under 1035. Dividend income, income from units of mutual fund and income from specified company under 1035. If such income is received, then no expense is allowed other than interest expense. No expense is allowed other than interest expense. However, maximum interest expense that is allowed, that is also 20% of income. 20% of income. See, for example, listen here. For example, there is a person called Miss S. Okay, Miss S received a dividend of 10 lakh rupees. Okay, from a company. For investing in the company, she took a loan from the bank of 10 crores and this 10 crores she invested in the company. Now, on this 10 crore loan amount, she is paying interest of 1 crore. On this 10 crore loan, she is paying interest of 1 crore. So, how much is the dividend? The dividend is just 10 lakhs. How much is the interest expense? Interest expense is 1 crore. So, what will be the income that will be taxable under income from other sources? So, see here, first you have to take the dividend income, that is 10 lakhs. Against the dividend income, you can claim interest as expense. So how much is the maximum interest allowed as expense? Number 1, take the actual interest and take 20% of dividend, whichever is lower will be allowed. So what is actual interest? 1 crore. 20% of dividend is how much? 2 lakhs. Whichever is lower will be allowed as expense. Hence 2 lakhs is allowed as expense. So income from other sources will be 8 lakh rupees. So against a dividend, no other expense is allowed, only interest expenses allowed. That too, maximum 20% of dividend income. I hope you are clear. Next, if any salary is received by member of parliament or member of legislative assembly, it is taxable under income from other sources. However, daily allowance and constituency allowance is exempt. Next, generally awards that are received are taxable. However, certain awards are also exempt, that you link it with exemption chapter. If any agricultural income is received outside India, it might be considered in income from other sources. Next, if any royalty income is also received, generally it is considered in income from other sources. And also last point, advance money. If any advance money is forfeited, then we learned in capital gain chapter itself that if it is forfeited on or after 1/4/2014, then in the year in which it is forfeited, it will be taxable under income from other sources. You get my point?
Now let us discuss the amendments in income from other sources chapter. Okay, in income from other sources, there is only amendment in section number 56 to 10, that is taxation of gifts. First amendment, that is in case of movable property. Okay, we learned that in case of movable property, this section is applicable only if the movable property is a jewelry, archaeological collection, drawing, painting, any other work of art, sculpture, bullion or shares and security. Now, one more asset has been added here, and that is virtual digital asset, which means cryptocurrency, Bitcoin, like Bitcoin, Ethereum, etc. So this also has been added in movable asset. However, this point is not there in CA inter syllabus, so you might also ignore, but still, if at all question is asked, you will be able to answer. Fine. Now also, there is amendment in exception of gift. Exception section. So first we learnt many exceptions where this section, that is 56 to 10, will not apply and the entire amount or asset that is received will be exempt from tax or will not be taxable. Okay. Now here two more points are added. That is point number 1. If the amount or asset is received by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of family for illness related to COVID-19, subject to conditions notified by central government. So what are they telling? if an individual has incurred any expenditure for COVID-19 treatment for himself or for family member, and for this expenditure this individual is receiving any amount from any person, then that entire amount will not be subject to tax under 56(2)(10). Hence it will not be taxable. You get my point? Now next point. By a member of family of a deceased person. Now let's say a person was suffering from COVID-19 and due to COVID-19 that person lost his or her life. In such case, if the family member is receiving money, then if the money is received from the employer of the deceased person, if employer is giving money, then there is no limit at all. Whatever money the employer is giving, entire amount will not be taxable under 56(2)(10). Then if the person giving the money is not the employer, if it is some other person, then the maximum amount exempt is 10 lakh rupees. 10 lakh rupees. So if the amount given is more than 10 lakhs, then the excess amount will be taxable under 56(2)(10). Up to 10 lakh rupees, it will be exempt under 56(2)(10). In which case, where the person has died due to COVID-19 and family member is receiving the money, either from employer of the dead person or from any other person. Okay. Where the cause of death of such person is illness due to COVID-19 and payment is received within 12 months from the date of death of such person. So this amount received from employer or from any other person should be received within 12 months from the date of death. Okay. And other conditions notified by central government. So firstly, let us learn what is the meaning of family in this particular provision. Here family means spouse, children and parents, brothers or sisters if dependent on the individual. Okay. So what is family? Spouse, children and parents, brothers or sisters if dependent on individual. Then conditions I have given here. Condition notified by central government, condition notified by central government. Now what are those conditions? Let us see. So for conditions, first I would like you to pause this video, note down the conditions and then unpause the video and watch the explanation. Okay. So what are the conditions, Kana? Condition number 1, point number 1. Death should be within 6 months of testing positive for COVID-19. Hence the death should have incurred within 6 months from the COVID-19 positive report or from the date of clinically being determined as COVID-19. So the day on which it is determined that the patient is COVID-19, from that date within 6 months only the death should have happened. Point number 2. Family members shall keep a record of the following documents. A. COVID-19 positive report or medical report if clinically determined to be COVID-19 positive. Hence COVID-19 positive report should be there. And next, medical report or death certificate issued by medical practitioner or competent authority in which it is stated that the death is related to COVID-19. So two documents should be there. COVID-19 positive report and second document is medical report or death certificate where it is written that the death is due to COVID-19. So these two documents should be there in case of a deceased person for whom the family member is receiving the money. Okay. And then second point, statement of any sum of money received by a member of a family of the deceased person from the employer or other person on account of death due to COVID-19 should be verified and furnished in form A. So the family member who is receiving the money from either the employer or any other person, okay, for the death of an individual due to COVID-19, all the details should have to be mentioned and furnished in form A. Okay. So if these conditions are satisfied, then what will happen? The amount that is received from employer, entire amount will not be taxable under 56(2)(10), and if the amount is received from other than employer, then up to 10 lakhs will not be taxable. Only the amount more than 10 lakhs will be taxable in the hands of family member. Okay, you get my point. So these two are the new exceptions added to 56(2)(10).
So let us discuss the remaining updates in income from other sources chapter. First and foremost, there is a change in section 56(2)(7)(b) from May 2024 examination
onwards. And what is that change? Now this section is applicable not only to a resident but also to a non-resident. So huge change that now angel tax is applicable not only to residents but also applicable to non-residents. Next, section 56 to 13 has been introduced in the Income Tax Act, but this section we will discuss along with deduction chapter. So after the deduction chapter, there are certain changes in deductions also that I will be explaining, and then along with that I will be discussing this new section also. Fine. Now let's come to the next section, and that is section 115 BBJ. Please make this correction. Section 115 BBJ, tax on winnings from online games. Now online games winnings has also been included first and foremost in the income definition, and now there is a separate tax for the online games, but it is same as section 115 BB. Okay, that is the tax on winnings from lottery, crossword puzzles, etc. So whatever section 115 BB says, same way even for winnings from online games, all the similar provisions will apply. Let us go through the provisions quickly. First and foremost, this section applies to net winnings from online games. So whatever winning from online game is there, that will be covered under section 115 BBJ. Meaning of online game. Online game is a game that is offered on the internet and is accessible by a user through a computer resource, including any telecommunication device. So it can be mobile phone, it can be iPad, it can be laptop, it can be desktop, it can be any telecommunication device. And in that device, using the internet, you are playing a game, and on winning that game you are getting a particular award or prize or any money. On that, tax is payable under section 115 BBJ. What is the rate of tax? It is flat 30% plus health and education cess and surcharge if applicable. Okay, 30% flat rate of tax. Next, is any expense allowed as deduction? No expense is allowed as deduction. No deduction is allowed. Okay, under chapter 6A, no loss is allowed. Basic exemption limit also you cannot set off. So all the restrictions which were applicable to lottery, same are also applicable to winnings from online games, and even the tax rate is same. Okay, so even in the special rates of tax, I have included the winnings from online games. There also you can note down. There also you need not note down, it is already given. Fine. 30% rate of tax. So for example, if any person is paying a game such as a PUBG tournament or a Fortnite tournament, or even in case of Dream 11, etc., whatever winnings is there, that will be taxable under this section. Okay, so that's it in income from other sources. See you in the next video. Till then, take care. Bye bye.